Hey Willie,
Yes.
we are now officially on Apple Podcast and Spotify. Congratulations.
Thank God we're on Spotify. No, that's awesome. I never thought I would be on any streaming platform for any reason.
I'm just surprised they approved us, so that's fantastic. We're now
They
you
still
can
have
listen
time to reject us, so don't get too excited.
so our listeners can listen to us on Apple Music, Spotify, YouTube, or watch on YouTube, unless you have a YouTube
Mm.
Premium.
Nope.
And they can watch on Twitter and all sorts of places. But we definitely prefer Apple Music or Spotify. Make it easier for everyone to listen to. So congratulations again. The first episode got a ton of views, so we really thank you
Hmm.
everybody for tuning into our first episode in the Finance podcast. Now we've had episodes before, but that was the first
Hmm.
official one for our new company, which we're very excited about. Now
Yep.
we're on episode two, and this episode, we're going to be talking about soft landing for the economy, which
Mm.
it doesn't make sense at all.
No,
We're looking at
this
these
economy is
numbers.
going to go like a bowling ball over a cliff.
Okay, look, let's not create fear. I don't think it'll go maybe not that far, but it could. Everyone's talking about the lawmakers, these economists, not all of them, these Fed people. I call them Fed
Hmm.
people because I can't even
The
call them Fed.
federalists.
Yeah, I'm losing respect for them by the minute. And all these bankers and these financial experts they call themselves, I just don't see where they're seeing this. All the data that's coming up that we're seeing,
Hmm.
all the issues that are arising, and just by speaking with and hanging around average Americans, I'm not saying
Hmm.
I don't mean that in a bad way. I'm just saying everyday Americans who are working hard, they're trying to take care of their
Yep.
families, or they're trying to get to the next level in their career. We're just hearing a lot of struggles people are having. And the data
Yes.
is showing that. We're
Yeah.
not seeing this soft landing they keep talking about how people are fine, they're fiscally okay, and all those sorts of things. So let's break down this data because I believe you and I have spoken about this, and I think you and
Hmm.
I will agree that these numbers don't add up. So let's
Right.
start with the Fed. I think you have a lot to
Uh,
say about the Fed.
the let's we can start and end with the source of the problem. So obviously, COVID was a bad thing, right? That's the understatement of the millennium. Uh, but while I'm sure everybody enjoyed their stimulus checks, we saw inflation run away. We saw everyone saying inflation is going to be transitory, as if somehow the forces of economics were going to be suspended by hopes and dreams. And honestly, the response that we've seen from the Fed since then has been absolutely tepid. We've mentioned that multiple times, and now we're seeing an unexpected kind of blowback to that, right? Normally you increase rates, interest rates, you slow inflation. But normally when you increase rates, you are actually taking chunks and aggressive bites out of it. You're not doing this 50 basis point garbage. And what I think it was, I just sent you the article from Bloomberg. We're in a position where the Fed actually have to increase their outlook for the rest of the year, right? They thought that 2023 was going to be, the start of a slowdown. But, the latest numbers, the economy is still solid. The Fed are going to need to double their projections for 2023 growth. The reports are strong for everything but consumer spending. And that doesn't that's not a good thing. That doesn't mean inflation's over. That doesn't mean that we're out of the woods. It just means that we're disguising the problem, right? And we've had this really horrible, spineless rate policy response, and that's on the one hand, it's supposed to be slowing down inflation, give us this unicorn-like soft landing. But on the other side, we mentioned before, consumer credits through the roof, over $1 trillion for the first time ever. We have strong wages. We have all of this counter pressure that is actually increasing inflation, right? Wages are strong and unemployment is low because companies are doing everything they can to attract talent, to retain talent, but that's putting more purchasing power back into the economy, right? So on the one hand, you have the Fed and Powell trying to hammer inflation really delicately, and on the other hand, you have companies that are desperate to keep output up, to keep production up, to keep talent on board, and they're going to crash, and it's going to be pretty ugly, to be
So,
perfectly honest.
so what you're saying is inflation is not over. It's actually
No.
it's stalled, but it's remaining high, and it's probably going to
Yep.
increase. Is what you're saying, and
Yeah.
this is a big problem. And a lot of the questions that we get are, don't we want people to do well? Don't we want people to keep spending? Don't we want people
Sure.
to get paid more? But we have to explain why that can also be a problem. Like, yes, we do want people to thrive and grow their wealth, but the
Yes.
problem is the Fed and Powell and lawmakers are part of the problem because they keep spending out of the ass when
Yep.
we all have to balance our checkbooks. So the
Right.
problem really is that they're not ripping the band-aid off sooner, and this is going to cause
Right.
a prolonged issue which is going to blow up in our faces. So
Yeah, that's a good way of putting it.
why should our listeners be worried about this? And there's a lot more we have to go through here, but just real quickly about that question we get asked a lot.
Sure.
They're asking, well, getting paid more is great. Don't want people to thrive.
Yeah. Well, I mean, everyone wants to get paid more, right? It doesn't matter if you're at the bottom or if you're Elon Musk, right? I want to get paid more. You want to get paid more. More money is more good. Fine. But how is that affecting the economy at large? And I'm not advocating that we should have pay cuts, but let's look at how that money is actually being spent. Because I mentioned before, and we talked about it previously, that the consumer credit level is astronomical, but that is mostly driven by credit purchases, right? And it's not
Mm-hmm.
just credit cards. Credit purchases also include auto loans, which I think was the average price of a new car in the country is like 40,000 or something like that,
Which
right?
is ridiculously high,
Right,
and it's
in
inching
an industry
it's inching towards 50 at a
that,
rapid
geez,
pace. Yeah,
okay, wow, yeah, I mean, an industry that produces the Kia Rio has no business having the average price of its goods be 40K or 50K, right? And the rates are still going up, which we're starting to see what happens anytime you have this problem, which is the default rates are increasing. Okay, the bankruptcy courts, I think they're the busiest this past August that they've ever been, right? We have the highest levels of default since 2008, which is the dirty four-letter word that nobody wants to say. But here we are repeating history. Okay, we have almost 240 billion in corporate bonds that are being traded distressed, and that's what people need to understand. You are not the only person. You're not the only economic entity that uses credit, right? The average American does not have $40,000 under their mattress to buy a new car. We drive our consumption a lot of the time through debt. Corporations do the exact same thing, right? Why would you spend $1 billion up front when you can finance $1 billion over 30 years? Okay. And that's what's going to get hit because the interest rate policy is going to directly affect the bond market, right? This just past month, over $3 billion in bankruptcies. The bank default rates that everyone thought, okay, Silicon Valley Bank was a horrible thing, but it's over. It's not over. Okay, the bank default rates are over 4% at the small ones. The larger ones, their increase is up 50% year on year. All right. This is a credit event that's approaching. What side it gets hit first, whether it's the consumer side or the corporate side, I don't know. I don't really think it matters, but one is going to drag down the other, right? Period. Because we either work
Right.
for companies or we buy from companies. Okay, whichever side gets hit with a credit event first is going to pull the other one down. Period. Okay, and we talked about wanting to get paid more, sure, but you also have also from Bloomberg. I don't know if you saw I think you saw the article because one of us sent it to you the other.
Yeah.
The GM union just rejected a 16% pay increase that was proposed. AT&T is saying, we're going to have higher prices for mobiles, even though unemployment is at the lowest that it's been in 7 months, and the Fed rate, what they call U3, is the lowest since 2000.
Right.
I think it's
So let me pause
3.8%.
you right there. So let me
Yeah,
pause you right there. So to simplify this for our listeners, I know there's a lot being thrown out, but what we're
yeah,
summarizing is that is not really a wage problem. Now, don't get me wrong, we do need to increase wages accordingly, and we have an idea about that. When
sure.
we'll get to that, but really what the problem is, inflation is causing prices to go up, and that's the issue. The cost of goods sold for the
Mm-hmm.
average American, or for anybody, whether you're a corporation or a family or an individual, you're paying more for
Yeah,
everything now, whether it's food, housing, entertainment, or AT&T looking for mobile price increases. That's the issue, is everyone's feeling the pinch because of inflation driving cost up. And it's just basic economics of supply and demand. And because they haven't ripped the Band-Aid off to drive
mm-hmm.
prices down when the unemployment is at an all-time low, what that's correlating is that people, yes, are working like never before, but prices are still going up,
Yeah,
and the wages can go up at the same time on pace. So that's
right.
causing a massive issue. So I think our listeners need to understand that it's not the matter of your wages increasing, it's the cost of goods sold, and inflation is driving that up. So to really
Yeah,
simplify, when policymakers are talking about wages increasing and the unions talk about wage increasing, we're not disagreeing with that wholeheartedly, but we are
right.
saying it's really about cost of goods. When you go to the store for just getting a couple items quickly and you don't leave without spending $100, that's a problem. That's a major problem. And how
Yeah.
that affects is called the trickle down effect. When
Mm-hmm.
inflation goes up, it's not only us paying higher, it's corporations who are making those items. So the cost
Yep.
to make things are going up, right? And then we increase wages, the cost to pay employees goes up. And taxes going up also causes a trickle down. So the issue is not really increasing wages are not going to help right now.
Right.
Increasing wages are again like what the Fed's doing with minor interest points
The
being
rate
raised,
hikes.
the rate hikes. It's just prolonging the issue, because
Yeah.
regardless if you raise the wages, you're everyone's still going to pay more. And based on what we're seeing, the pace of cost of goods sold is not keeping up with wages. So what is happening with policymakers and the Fed and Powell? What they're doing is creating literally a stew of crap for the
Yeah.
economy.
It's a feedback loop.
Exactly. And when you
Yeah.
see issues now with the world, with China, with Europe, and with
Mm-hmm.
other economies, they're seeing the same issues, and that's going to trickle effect to us. So for our
Yeah.
listeners, hopefully that helps simplify it a bit more and better understand why this is such an issue, and why you also shouldn't fall for the, I'm afraid to say it, bull crap. I can't really, I'm trying to keep this very clean
Don't
as
get us
possible.
demonetized.
Yeah, exactly. There is no soft landing. Right now,
No.
you're feeling that turbulence, and that turbulence is not going away. And uh, unless something happens sooner with the Fed, it may be too late.
Yeah.
I think it may be too late. I think we're
Yeah.
at a point right now where it's almost impossible to get the soft landing, and we have to fall on our faces in order to
Yeah.
get to where we need to go. And the last thing I'll say before we not move on, but we'll go a couple more data points just so people understand is you're looking at the S&P, right? You're looking at how companies are trading. They're trading about 19 to 20 times their revenues, right?
Mm-hmm.
You're looking at the markets right now, how they're reacting. They're predicting a soft landing, but yet it doesn't make any sense. And
Right.
5 to 7 companies are driving that market. They're trading 19 to 20 when the rest are going 3 to 4%. So that's
Yeah.
also playing a huge factor as well. So you can't really blame companies for these bonuses, for their profit margins, because we hear that a lot from people saying,
Mm-hmm.
oh my gosh, they're so bloated, they're treating themselves, they're not doing all that. That's all being done by these investment bankers in these markets that are trying to understand, are we having a soft landing or not? And this is
Yeah.
again an effect by the poor decisions of not ripping the band-aid off and prolonging this. So it's allowing the markets to misbehave, and that's
Yeah.
going to be a big issue as well. So when you're having these companies trading 19 to 20x when they shouldn't be, really they should be trading maybe half of that or a little bit less based
Mm-hmm.
on revenues and these P&Ls and these reports coming out, the proxy reports that we read. That is an issue. So for everyone listening, you can't really blame these companies for these, bonuses, right? And you can't really blame, or you can't really say, oh, wages should go up. No, it's really cost of goods
Yeah.
sold that should be worked on to go down. Inflation needs to go down, and all of us are going to pay a much bigger price, and it's going to hurt a lot more because of the failed decisions by the Fed and our policymakers.
Yeah.
So that's really where I'm coming from. And I think you agree, and
Yeah.
it's going to be. I think next year is going to hurt quite a bit.
Well, I think you have a disconnect from reality, which is the understatement of the day. Right. On the consumer side, you brought up wages. Wages are not the problem. They're part of it, but we're not saying that you should pay people less, right? If I say, hey, boss man, hey, boss lady, I want more money because I'm valuable and I'm spending all my cash on groceries to feed my kids. Okay, fine. But the worst thing that you can do is bake in the expectation of inflation. I think markets are completely out of their minds, to put it politely. You know, companies they can cut press releases and say yes, we have a rosy outlook, whatever. Look at how they're spending their money. Okay, not in the proxy reports, not in the management discussion section of their annual filings. Are they spending their money like they believe we're headed for a recession? Okay, the investment bankers, sure, they're going to want stocks to always go up because that's their job. The traders, that's their job. They want to present this idea of everything's in the clear. I mean, we had I forget his name, one of the executives from Goldman. I think it was this past week. Said in an interview that
Don't get me
the
started.
effect that the effects of the Fed interest rate policy may have topped out. We may have reached peak effectiveness. That's not good news.
Oh yeah,
Okay,
he's chief economist, correct?
right, right. Okay, yes, and people celebrate that, like, oh well, okay, that must mean somehow inflation's over. That's some of the worst news that you could hear because the Fed don't have that many tools to control inflation. You can mess with interest rates or you can print money. That's pretty much it. And if the effects of rate policy have actually topped out, this is catastrophic, right? It's not going to be a soft landing. The soft landing is out the window. Okay, we
Right.
should have raised rates in 1% chunks, 2 years ago, right? And I think people, again, not financial advice, etc. Sorry, legal department. We're covered now. I think people need to prepare for something that is catastrophic that we haven't seen for decades.
Right. And everyone should be prepared regardless in a good economy or a bad economy.
Sure.
But why does all this matter? This is where I think the Fed loses track. Yes, they have some key numbers and data points that they look at, that the whole market looks at. I mean, we do too. But we like to
Hmm.
look at the underlying numbers that matter. We see here that many, 60%, I believe,
Hmm.
from a survey, don't have $1,000 to cover an emergency. Think about that.
Yeah.
Uh,
Yeah.
They they don't have $1,000 emergency fund. Housing affordability, just today, Bloomberg released, housing affordability is at its worst in history.
Yeah.
Homes
For
have been
the NAR report.
right. It's been unaffordable like any time before. Car prices we mentioned earlier, all time high. The average, like you said, I'm not buying a Kia for $40,000, $50,000. Are you kidding me? Credit credit card debt is at an all time high. It crossed $1 trillion.
Hmm.
The U.S. debt as a government is at an all time high.
Hmm.
So, as you said, the fact that chief economists like the Goldman Sachs one, and the fact that other economists are saying we're going to have a soft landing, that's a major concern because they
Yeah.
have their blinders on. And this reminds us of what? 2008. Remember the blinders they had on? It reminds us of the late 70s. They had their blinders on and everything in
Hmm.
between. Dot-com bubble.
Yeah.
Everyone is having their blinders on. And when we see this much optimism, when we see this much, not only optimism, but we see much optimism, but then these underlying data points not showing. And when we hear people struggling with paying their bills, cost of goods going up, and we see food stamps at an all-time high.
Yeah.
How are people able to say we have a soft landing, and how are lawmakers and folks that make the decision at the Fed not seeing this? I rather us suffer more temporarily, real quick, let's say
Hmm.
3 to 6 months, than to crash and burn a year later. Because
Sure.
we've seen before, our economy and Americans can be very resilient. But let's see what happens here because we are at a really interesting time. And look, we're not fear mongers, right? We have a lot of optimism. We love the American economy is always resilient. The way we invest at Garrison Fathom is always long term because the American
Hmm.
economy always rebounds, and it will. We're just
Right.
saying it's going to be a bit of a rough patch before it comes back. But if you zoom out in the U.S. market, the S&P, we always come back and we always win more and more down the road. That's how we look at
Sure.
investing. The problem is the short traders and all those folks. Sorry, I probably offend them all the time, but I don't care. They're part of the problem,
We don't
right?
work for them.
I was at a meeting a week or two ago, and they were practically selling me a different MBS that reminded me of '08. It was just repackaged and reworded. I'm going, wait a
Yeah,
minute.
but this time it's different.
Right, right. And I'm going, wait a minute. Why would I even touch commercial real estate right now or residential real estate? It does not make sense
No.
at all. So
No.
all of these are huge red flags. And I think our listeners are now going, oh, so what do we do about it? Right. And that's why we're here. I think, again, it's not financial advice, but these are the things that we would do and we would advise our friends on. And I think you had some key notes here that matter. And I believe you said this quite some time now. And it's something I worry about. And we wrote a piece about on the Garrison Fathom blog, which is stagflation being a real threat. Do you want to dive a little deeper into that? Because
Oh,
I know
just
Europe is practically there. Europe is practically in
the
stagflation, and the U.S. is knocking on the door.
yeah, that's I think everyone on the Hill just shuddered when you said the dirty word of economics. Uh, I mean, yeah, for those not familiar, stagflation probably one of the worst things that can happen economically. Like if you look at the history of economic policy, this was stagflation is not even supposed to be possible. right? Stag is in your bachelor party, inflation as in what's going to happen to destroy whatever little is left in your wallet, right? But if you look at the traditional, what they call the Keynesian economists, data going back to the 1860s said stagflation is never going to happen. You cannot have high inflation with unstable economic growth. You cannot have high inflation with a very stagnant, non-growing, or even shrinking economy. Here's 100+ years of data that show these things move in opposite directions. Well, and yet in the 1970s that happened, and we have the perfect conditions for it right now. Okay, in the 1970s, and you love saying history doesn't repeat, but it rhymes. So let's see how much of this sounds familiar. Okay, in the 1970s, pre-stagflation, you had huge social spending programs like the Great Society. We have huge social spending programs now. You have oil prices that were increasing continually. We kind of have had that since the start of the
And it's getting
war of
worse, by the
Russian
way.
aggression.
Right, just
Yes.
real quick, it's getting worse. It just crossed over $90 again for the first time this year, and Saudi
Yeah.
Arabia and OPEC have agreed to keep the oil production low.
Yeah. Yeah. Was it 1 million barrels a day
Yep,
that they're
to
cutting
continue to
production?
keep it low. Yep, to continue to cut the
Yeah.
production.
So you had back then oil prices were increasing more or less continually. Nowadays, since the start of the Russian aggression, you have oil prices continuing again, and you have economic pressures that are influenced by embargoes. Hmm. I mean that sounds very familiar. What you don't have now that you did have back then is a Federal Reserve that was led by someone who's actually willing to do something about it. Right back then, it was Volcker. Today, maybe one of us in 30 years. The problem better be solved by then. Okay, but here's what's going to happen. You have the perfect conditions for unemployment to inevitably increase. Okay, businesses cannot keep passing on their costs to the consumer. You can't pay people more money on the one hand to keep them employed, while on the other hand, you keep jacking up prices, right? You have to have the interest rates going up. Okay, so there are three forces that are going to make borrowing more expensive, that are going to make your money less useful, and that, like I said before, you have a situation where people are expecting inflation and it's going to happen because they're expecting it. Okay, the Fed has already stated that they are willing to accept a higher inflation rate to save unemployment. Okay, it was true back then, and it's true now. The only difference is back then, like I said, Volcker jacked up rates to over 20%, and it took two, not one, but two major recessions, pretty much back to back, to fix the problem. Okay, we're supposed to avoid that, right? You said it's a failure of leadership. Okay, well, you know what? Lawmakers exist for reelection. No one wants to say the uncomfortable truth. The regulators serve at the pleasure of management. Powell has already been taken to task at least once by Senator Warren over the threat of recession, over the impact of interest rates on the average American. And that's the damn thing, is that she's right. Inflation is going to cause pain to combat. But what pain do you want? Do you want the pain of expensive credit? Do you want the pain of having to cut back on loans, on purchases, on whatever, or do you want the pain of unemployment? Those are your choices. And the fact that we seem to be staring down both barrels right now means we probably don't get to make that decision. That decision is going to be made for us. And because we had that spineless attack on inflation in 2021 and through 2022, we have been robbed of that autonomy. We don't get to make a choice anymore. We got to buckle up, period.
Right, and ironically, there are opportunities here. And I
Sure.
believe there's folks out there that are lawmakers that don't understand that even if money is tight for the average American, if they have the financial knowledge, they can
Hmm.
survive the short temporary pain, which is what it should be, instead of a prolonged pain that's going to lead us off a cliff and
Yeah.
where you hope that parachute works. And
It only works
this
if
is
it's made of gold.
right. And exactly. And this is where our listeners should listen very carefully, right? As we explain, this prolonged pain of cost of goods being all time high, credit's getting tighter, and people are feeling it. I don't care who you are, everyone's feeling it. I saw I saw there's an article from Bloomberg or Wall Street Journal that even the upper middle class and millionaires are now shopping at the dollar store, right? That tells
Yeah.
you everything right there. So whether the Fed gets their act together or whatnot, you yourself, our listeners, need to be prepared regardless, right? We're in a prolonged period of pain, which should have been a lot shorter, but
Hmm.
there's not much we could do right now. This is going to end up being pretty bad in 2024. And there are some economists out there that agree with us, luckily, and
The smartest ones.
the
It
smartest
should be
ones.
noted. Shameless
So,
plug.
right. So, what our listeners should do is really start being very careful how they spend. Spending discipline is going to be key because you shouldn't be overspending right now, right?
Yeah.
You should be able to pay for $1,000 emergency, right? And we're not saying don't be miserable and don't not do anything. We're just saying make sure you balance your books and make sure you have a strong savings reserve for yourself and your family. And this is again a great opportunity from a standpoint of letting your cash work for you. So in this type of environment, interest rates being high actually helps you with savings accounts if you're at the right
Hmm.
place, right? If you have the
Yep.
right strategy. So what we are doing, again, not financial advice, but what we are doing, so folks understand, personally and at a business level, is the cash that we have sitting, we're making it work for us. So yes, we're holding a lot of our cash right now. Reason being is because we explained before, the markets are outrageous, everything is overpriced. And even personally, spending has been limited because we see what's going on. And with the cash that we have, both personally, I know you are doing this too, and from our
Hmm.
companies, is that we're putting into high interest APY earning accounts. Capital One is
Hmm.
fantastic. We've been telling a lot of
Yep.
folks to do that, right? It's earning what, 4.3% APY, which is
About that, yeah.
fantastic,
Yep.
right? And Vanguard right now is a 4.7%. So there is a lot of high earning, and then treasury yields. You want to get into that. For the company, we're
Yeah.
doing a lot of that. Now that requires more sophistication, but once you learn about it, it takes probably 15, 20 minutes to learn how to do and what's all about. And we can probably put an article out or an episode out on how to do that. But they're earning
Yeah.
over 5% across the board. What that means is you're earning 5% yield, right? So there are
Yeah.
a lot of ways to make your money work for you. And you should not have your money just sitting there at a
Right.
0.2% earning or not earning, right? I had a friend of mine who told me he had a very large amount in his savings, which I was very proud of, which is fantastic. He's a younger gentleman. But I'm going, where is that money sitting at? And I believe it's sitting
Mhm.
at like not Wales, a Wells Fargo savings account, which is, first off, Wells Fargo is a horrible bank, but
Yeah.
it's in a savings account that's earning probably 0.25% at most.
Right.
What
Right.
when he can easily put that in a Capital One uh, or a Vanguard high earnings, and he could be earning a ton of money. Let's say it's 15,000, right?
Yeah.
Let's say that's the number. 15,000 will earn you $700 or more per year on just letting
Yeah.
your cash park there
Yeah.
in the Capital One account of 4.3%. It'll be a little bit more in Vanguard. So
Yeah.
we really urge our listeners to shop around because it takes, there's no fees, right? It takes little
Hmm.
effort. and you're losing out on a lot of free cash practically. So again, that's the one benefit of a market that we're in, is that you're going to be able to have more options and high earning accounts. Even Apple's credit card, right? Apple has a savings account
Right.
now that's earning
The Bank of Cupertino.
4.15%. Exactly. It's earning 4.15% as well. I'm probably a lot of our listeners have that. So, end of the day, really look at options. Consumers have the power now. You can still keep your check-ins, let's say at Wells Fargo, because checking is just checkings, right? But
Yeah.
savings, you need to be able to diversify yourself and earn on it. And then from an investment standpoint, yes, we said that we're holding our cash, but it's still safe to put it in a long-term ETF like a Vanguard, VOO, or whatnot, because that's always going to win in the long run. So make the best decisions for yourself, but there are high-earning accounts out there. So don't waste your cash sitting there not earning for you, because you got to fight inflation, right? I mean,
Mm-hmm.
what's the inflation rate right now? What's around?
I think it was 4% or so. Last
Yeah,
CPI print.
so let's say it's 4%, right? And you're earning 4.3%, Capital One or 4.7, a Vanguard. You're beating inflation. You're literally beating
Right.
inflation. But by putting your cash in like in a 0.25% APY, you're losing
Yeah. You might
over
as well light it
three.
on fire because it's going to have
Yeah,
the exact same result.
yeah. So not only
Um,
are cost of goods high, but then you're also losing 3.75% in value of your dollar. So
mhm.
hopefully this lights a fire in our listeners and they listen to us on this. But do you have anything else to add to that?
Well, I mean, we always keep talking about the long term, and you brought up the example. If you have 15,000 in savings, okay, you what is it? You said you get 700 in
Yeah.
yields for that year. Okay, this is why I think the long term strategy is the only way to go. Like the average person, like, oh well, I mean, if I magically had $15,000, I'm only going to earn 700 bucks on it. I don't get it. Why? But you don't understand. Like you earn 700 for the first year. The next year, you're not starting at 15,000. You're starting at 15,700, and you're
Bingo,
earning on
compounding.
that. It's called the snowball effect. If you treat your savings as something for an emergency, which, God forbid doesn't happen, or if you treat it as something to augment your retirement savings, over time that $15,000 can add up to a hell of a lot of money. 15
Absolutely.
thousand over 30 years, earning 4% a year, 5% a year, whatever. I'm not going to do arithmetic in public because that's dangerous. But go online, find a compound interest calculator, and you'll be amazed at what that money can turn into. And again, these are places to park your money that are as risk free as you're going to get. Right? Like I prefer treasuries. You prefer treasuries for the company stuff, right? Uh, but do something. Don't let it fester in a 0.25 or whatever the hell you said Wells Fargo are offering. You know, take care of yourself, right? And
Right.
you have to remember that the traditional mentality doesn't necessarily always apply, right? Like why are we plugging high interest savings account? Well, because historically in this type of situation, macro situation, everyone tells you to invest in real estate. I don't have to tell you why that's a stupid idea right now.
Exactly.
But
High
it's like
risk,
something.
costs too much, and part of some BS real estate advisor or agent and some stupid banker who just wants that
don't,
quick
don't
sale.
say the
It's
name.
gonna,
Do not say their name.
yeah, it's gonna screw you because they don't care about you. End of the day, they care about their commissions. They don't care about
Yes,
you. We actually
correct.
do. This is why we're building a company called Finance, and we're trying to educate you, the listeners, because we want to help everyday people to be able to
Yeah.
thrive, right? And just real quick, the
Mm,
compounding thing is beautiful, right? That's how you can be a millionaire by the time you're middle age if you do it early enough. But even if you
yeah.
don't do it early enough, you can still make hundreds of thousands by compounding. That's the beauty of it.
Yeah.
And the reason why I said on 15,000, someone's going to do the math, right? It's going to save $647. But the reason why I said 700 is because of the compounding, right? Because in the first month, right, you're going to earn on that, and then the second month, it's not actually 15,000; it's 15,000 plus your interest
That little delta.
Exactly, and then the third month, so it keeps going up and up. So, just to be clear, that's how compounding works. And again, whether you do high earning savings, whether it's Apple 4.15, Capital One 4.3, or Vanguard 4.7, or you do Treasuries, which are over 5%. Regardless of all that, you're beating inflation, and that's what matters, and that's what's going to help you make sure your cash is earning for you and you're beating inflation. Now, the cost of goods sold, it's going to be bad, but at least you're earning on that cash that's sitting there.
Yeah, I mean, it's things like that. Investing is the only way that you can go from abject poverty to comfortable in a generation within your own lifetime. I mean, would it be nice to go from abject poverty to 3 times Elon Musk's wealth in 16 months? Yeah, hell yeah, I would love to do that. The chances of that happening are very low. But when you do things like what you were mentioning, the Vanguard accounts, the high yield savings account, the treasuries, when you invest your money wisely and you just have the patience and the discipline to do absolutely nothing, and to not prove how clever you are or to not follow a hot tip or whatever. When you have the discipline to do nothing, it's incredible how productive doing nothing can actually be in the long run.
Patience wins. Patience always wins. And investing is not for the short-term minded. It's for the long-term minded. And look, not everyone's an entrepreneur, right? You mentioned Elon. Not everyone's an entrepreneur. Not everyone is able to take on that kind of stress, that kind of high risk. We do that, but we actually do both. We are long-term investors at Garrison Fathom, but we also take high risk as entrepreneurs with finance and other ventures that we're on. Not everyone can do that.
I mean, you want to talk about risk? My hair used to be here. This is where my hairline used to be before I started working with you and doing entrepreneurship. Now look where it is. This is the price that you pay.
And I actually noticed that I'm starting to get gray hair. I'm only 31. Oh boy, about to turn 32. So, and look, to our listeners, that's fine. Be comfortable with who you are and what you're able to do. Just do the basics right, and you'll be okay. That's the thing that everyone has to remind themselves on. Patience will win, and just do the basics right. Don't wait to do it. Do it now. Be patient, and you'll win out. So whether you want to rent or buy, we prefer rent right now, and make sure you have a runway. I like 6-month runways, 6 to 12 months, 6-month minimum. So make sure you build a 6-month minimum, and that's 6 months of cash that you have. Make sure it earns over 4%, which is plenty of options out there. And then just be patient, because we have to ride this out now because of the leadership that we're in, and with the decisions by the Fed and everyone. This is going to end up being much more painful than it should be. And those are the last words I have. How about you? Anything else you have to say?
I think that's well spoken. My soapbox is in danger of collapsing under the weight of my words, so I don't think I'll be brave enough to add to that. I think you summed it up beautifully.
Sounds good. And to our listeners, if you have any questions or comments, please feel free to direct that in our DMs or our emails or whatnot. So tweet at us, whatever you feel. We want to hear from you, and we hope this is helpful. And we look forward to hearing from you. And next episode coming up next week. Cheers.
Yep.